Mortgage rates. We thought that by now they would be lower, but we've seen stable rates all year. Higher mortgage rates mean higher monthly payments, which means a higher bar for new investors to get into the market. So if you see a low rate in the wild, should you jump on it? My name is Ashley Kehr, and I'm the host of the BiggerPockets Real Estate Rookie Podcast. In this video, I'm going to tell you why a low rate loan might not be all it's cracked up to be. There are other factors to consider. I have learned from experience that interest rate is not the only factor to consider when shopping loan products. Before we get into the video, take a moment to comment below what interest rate you have on a loan you currently got. As we go through the video, you will learn that interest rates can't be compared apples to apples without all the information. Just like you can't compare your cash flow to someone else's without knowing more information about the deal, such as how much cash they have put into the deal. Besides interest rate, there are other factors that determine your loan product terms. We will go through each one so you have an understanding of each. The first is your down payment. Your interest rate will vary depending on how much money you can put down. More money down is usually less risk for the lender since there is more equity in the property now. The next is the amortization period. What is the period of time the payments are spread out over? This is commonly 15, 20, or even 30 years. This does not mean how long until your last payment, as there could also be a balloon payment where your loan is due before the amortization period ends. You make your payments up until the balloon payment, where you pay the remaining balance in full. During the amortization period, there's also a period of time where your interest rate is fixed. This could be during the whole length of the loan, or this could be the first 5, 7, or 10 years. This can also vary depending on the loan product. After that period of time, the interest rate will become variable, meaning you are no longer guaranteed the rate, and it can be constantly changing with the market. You will be given a floor amount and a maximum amount. The rate will not go below or above those two rates. Let me give you a real life example. One of my partners bought a primary residence that he was going to house hack. It had 2 units. He went to a small local bank and decided on the following product they had to offer. It was a 20% down, 30-year amortization with a 5.25% fixed rate for 7 years and variable interest rate for the next 23 years. So as you can see, there was a fixed rate and adjusted rate throughout the remainder of the loan after those 7 years. Now remember, the interest rate will change your monthly payment. A huge increase in interest rate could kill your cash flow. For that example, we just saw that he had a 5.25% interest rate in 2023, we would think, wow, what bank did he use? I want that rate. But in reality, it may not be in your best interest to do a variable rate loan. See what I mean? In comparing apples to apples, there is always more information that you need. That example was from a small community bank, but there are lenders offering low rates, and they might be from bigger companies that don't give you individualized attention though. Does this matter to you? That's for you to decide. In my opinion, once you have the loan in place, there really is no need for hands-on customer service. I set up automatic payments and set it and forget it. Most companies have your tax and monthly statements available online, so there is really no need for me to speak to someone or have the individualized attention. During the loan processing, that's a different story. I would rather pay a little higher interest rate to work with a competent and efficient loan officer. There is so much involved in getting the financing in place, and the last thing you want is for your deal to fall through because you didn't get your financing in place. The first time I ever got bank financing for an investment property, I went to the bank I had my primary. They had the lowest interest rate. Instead of the loan officer who had done the construction loan for my primary, I was working with a new one. My commitment date was getting close, and I called the manager to see if she needed anything else. Finally, I stepped in and found out the manager hadn't even entered my information into their system yet. I took my folder and ran. I ended up going with a recommendation from my real estate agent. I was able to get the deal done. This was my first learning experience of many that customer service and the smooth process means more to me than the lowest rate. In that scenario, I could have fallen out of contract and lost the deal. It's one of my best rentals to date. If you're liking this video so far, make sure to hit the thumbs up so more investors like you can find this video. So we've learned interest rate and customer service are not the only thing you should compare. You should also compare interest rate with other costs that are associated with the loan. The closing costs and fees can quickly add up. First up is to ask a loan officer for all the closing costs. They should be able to provide you with an estimated closing disclosure. You can find a sample copy of this on consumerfinance.gov. On this disclosure, it will show you your interest rate, loan amount, monthly payment, escrow amount, and all the fees and closing costs, which will total to your estimated cash needed to close. The cash needed to close will include your down payment, usually a year's payment in advance for insurance premiums. And if you are doing escrow, then a year of property taxes in advance will be required to pay your property taxes for the coming year. These are costs you would have to pay anyways, and most banks will require you to pay upfront. There will also be two sections. One section is where the costs are absolutely non-negotiable, and the other is where your loan servicer will be able to shop for prices. Non-negotiable fees that can't be shopped for are the appraisal, and then lots of fees such as flood zone fee to see if the property is in a flood zone, and several other things. Then for fees that are shopped for, this could include the survey and different title fees. Many of those fees are pretty standard in both categories, but it is important to understand them and make sure that it isn't anything out of the ordinary. These fees will vary by state and sometimes even by the county the property will be recorded in. Then we get into the fees that can vary depending who you use. Along with the interest rates, you will want to shop these fees and use them when comparing loan products. This will include your origination fee or commitment fee. This is the fee the lender is charging you to do your loan. Sometimes, especially on the commercial side of lending, this fee could be due when you get your commitment letter and you'll pay it ahead of closing. There could also be points on the loan. So this is where you will have to run the numbers to see if it makes sense to pay an additional fee upfront in order to save an interest. Or does it make sense to pay the higher interest rate because it would take 10 years for you to pay the points over time? Another comparable for loan products is a prepayment penalty. Some loans may require that you pay a fee if you pay down a portion or all of the loan within X amount of years. This could be over 1 year or even up to 10 years. It is usually on a sliding scale. For example, on year 1, you would be charged 5% of the total loan amount paid off early, and in year 5, it may be 1%. Then in year 6, there is no penalty. What are your plans for the property? Take this into consideration when deciding if you want a prepayment penalty or not. Oftentimes, you can get a better interest rate if you do accept a prepayment penalty. The last thing I will add on this is to ask your loan officer what the insurance requirements are of the loan product. This can play a factor into your cost for the property, not at closing, but for the life of the loan. If the insurance requirements are ridiculous, then it could cause you to have a property that has an expensive premium. This can always eat away at your monthly expenses. Reasons this could happen is that the loan product requires better coverage than you are used to getting, or requires something that isn't common coverage in your state, and you are limited to the providers who can cover you. This actually happened to me. I was doing a commercial line of credit, and the coverage was almost impossible to find that would meet their criteria. I had to get a commercial insurance policy, which was more expensive than any other duplex I had coverage on. We are now going to move into loan regulations, but first, thank you for watching this video and subscribing to BiggerPockets. Without you, then we can't help more and more people get started in the real estate investing to grow our rookie community. So loan officers that aren't investor friendly may not know the nuances of investing and can miss both regulations for investors as well as for benefits you could be getting and as an investor. There are many different loan products out there that are specific to real estate investors. In most cases, you must be flipping the property, turning it into a short-term, mid-term, or long-term rental. Flippers can oftentimes get short-term loan products that could even cover the rehab costs of your project. There are hard money lenders that offer these loan products, but sometimes small local banks will too. Loan officers don't always understand investors. If you are getting an investor-friendly lender, they will know you are adding value to the property. Some loan products will give you 100% of the capital needed to purchase the property and rehab it if there is enough margin in the ARV. A loan officer who primarily focuses on residential homes is not going to have knowledge of these loan products or take the time to research them, since they already have their bread and butter of lending on primary residences and the only one-off investment property where they require 20 to 25% down. Another investor-friendly loan product that is available is a DSCR loan. The This is a debt service coverage ratio loan. This loan is for investors with the intent to rent out a property. The bank will consider what the income is on the property instead of what your personal income is. The idea of this loan product is that your rental income will cover the monthly expenses of the rental, including the mortgage payment, insurance, and property taxes. An investor-friendly lender will also know what the regulations are that are required for investor-specific loans. This includes what you can and cannot do with the property based on the loan type. If there are any points available to pay to get a lower interest rate, or if there's funding for rehabs, along with the many other things. One last benefit that an investor-friendly lender is more familiar with looking at income of a real estate investor and understanding their tax returns along with their businesses, compared to a loan officer who is more familiar with asking for W-2 income and having doubts about lending to anyone who doesn't have that type of income. As you can see, there are many benefits to working with an investor-friendly lender. You should always work with one. If you don't have a trusted lender yet, you can find one for free at BiggerPockets.com/find-a-lender. Even if you are just getting started, you can always connect with the lender to understand what will be needed of you when you are ready to offer on a property. They can also provide you with information on current loan products and rates, which will help you run your numbers. So head over to BiggerPockets.com/find-a-lender and meet your match to get your next real estate deal closed. You can connect with me on the BiggerPockets Real Estate Rookie podcast and on BiggerPockets.com by searching my name, Ashley Kehr. You can find me on Instagram at Wealth from Rentals, and don't forget to follow at BiggerPockets on Instagram to find up-to-date information on things to help you with your real estate investing journey. Make sure to subscribe and like this video so I can bring you more information to further your real estate investing journey.